Good morning, everyone. Thank you for joining the Hazer Group Strategy Update webinar. On the call today, we are joined by Glenn Corey, Managing Director and CEO, and members of the executive team. We will answer your submitted questions at the end of the presentation. We have received some questions in advance. However, there's also a live facility. If you'd like to ask a question, please use the written Q&A facility at the bottom of the screen at any time during the webinar. I will now hand over to Glenn to begin.
Thanks, Krista. Hello, everyone, and welcome to our strategy update briefing. Thank you for joining the call. As Krista said, I'm Glenn Corey, the CEO and the Managing Director of the Hazer Group. Joining me on the call today is Mark Edwards, our Chief Operating Officer, Neil Brodie, our Interim CFO, and Luke Cox, our Chief Commercial Officer. You can read our bios and the bios of the board and the other management team on slide 5. Given our most recent project deals and our announcements in particular in Japan and in Europe, as well as our CDP update of a couple of weeks ago, we felt it was a really good time to provide an update on our strategy. It's the first time we've done this for Hazer, so we're excited to be sharing our latest view on our strategic direction and, importantly, aspects of our business model. Our strategy will continuously evolve as we update it and pass through key milestones of the company and achieve underlying growth in our business. Today, I'll say that our strategy is on track. We are focused on the key priorities of our business, driving towards our transformational milestones, and at the same time, meeting the demands of our customers for our technology. I engage frequently with energy giants, industrial groups, investment firms globally, government representatives worldwide, and they all say the same thing. Climate change is real and it's accelerating the energy transition, which is a priority for our countries and for the corporations globally. We are witnessing this firsthand, and we're proud to be playing a role as a technology provider in this space. Hydrogen is an exciting space to be in at the moment. We're very well placed as a company to support decarbonisation strategies worldwide today, with a disruptive climate technology that can provide clean, low-cost energy to our customers. Here's the agenda for today. I will give a brief update on the corporately. I will then go through our investment highlights very briefly before handing it over to Mark to give an update on all the good progress that we're making on our commercial demonstration plant. He will hand over to Luke, who will give an update and present our latest in terms of our project pipeline. And Neil will round it out with the growth and the monetization of our business before we wrap up and go into Q&A. I'd expect the presentation to run for about 30 to 35 minutes, and we'll leave plenty of time at the end for your questions. Just to recap, Hazer is developing a low-cost, low-emissions methane pyrolysis technology that essentially takes natural gas and methane as a feedstock, which is 25 times more harmful than carbon dioxide. And using iron ore as a catalyst, we split it into pure and clean hydrogen and solid carbon in the form of graphite. The iron ore, which is cheap and of course abundant, is our competitive advantage for 2 reasons. Firstly, it significantly reduces the energy requirement of our process, therefore resulting in much lower temperatures of our operation. And secondly, it enables the production of very high quality graphite. So we are essentially one technology that serves 3 very valuable markets: the hydrogen market, the graphite market, and the decarbonisation market. And it's the latter that is proving to attract quite significant attention and interest in our technology. Corporately, our largest shareholder is AP Ventures. They are a leading global hydrogen investment growth capital fund, which has the backing of some very sophisticated and notable investors, including Mitsubishi, Sumitomo, Equinor, Anglo American, as well as the Temasek Group in Singapore. And it's very strong validation for us and our story and our technology that we have a substantial holder from a very sophisticated investor. Other things to point out here is we have an adjusted cash position of just shy of $18 million following the receipt of our R&D rebate cash refund, which significantly shores up our liquidity. And it's worth mentioning as well that we have spent $70 million to date on developing the technology. So it really just represents the scale of the investment that we have made in developing and advancing the Hazer process. We'd like to just share a short video with you that highlights, we think, a very nice summary of our technology.
Hazer, a low-emission, low-cost hydrogen and graphite production process. The Hazer process enables the effective conversion of natural gas into hydrogen and high-quality graphite using iron ore as a process catalyst. Welcome to the Hazer pilot plant, transforming today's commodities into clean energy and materials for tomorrow. The Hazer pilot plant uses natural gas as its primary feedstock. The gas is stored as LNG, which is regasified and fed through the main gas manifold before being taken to the reactor to commence the Hazer process. The Hazer plant is based on a reactor called the fluidized bed reactor, where solids and gases can freely mix to enable the efficient conversion of natural gas into hydrogen and graphite. The reactor is heated to approximately 900 degrees Celsius. The gas is forced through a distributor plate within the reactor. The velocity suspends the iron catalyst or graphitic particles in the flow of gas. The catalyst is fluidized, suspended in the gas, and mixing the solid sand-like particles with the natural gas. In this process, the methane molecules and the natural gas interact with the surface of the catalyst, decomposing into hydrogen and graphite. Under these conditions, the catalyst disintegrates into nanofragments, a process known as dusting. The graphite is deposited on the surface of these tiny catalyst particles, while the hydrogen is released and mixes with the original natural gas feed. The graphite accumulates on the surface of the catalyst particle, reducing its density, which allows it to be liberated from the catalyst bed via the passing gas stream. The reactor expels a combination of gases, unreacted natural gas, and the hydrogen product, as well as the solid graphite particles. This stream is filtered with sintered metal plates, yielding high purity graphite with minor amounts of encapsulated catalyst. After removing the solid graphite, the gas from the reactor can then be purified to remove the methane and any other byproducts, leaving pure hydrogen that can be used as an industrial chemical for the clean energy applications, as a fuel for vehicles or for power generation. The Hazer process has now created two new products, a raw 80 to 95% purity graphite product and hydrogen. The gas has been transformed.
Very good. And that video is available on our website for those who would like to return to it. In terms of strategy, we have spent the last 6 to 9 months developing what we think is a very robust strategy for the Hazer Group, really highlighting where we are today in terms of commercializing our business. I've often referred to Hazer as a double bottom line company, aiming to deliver sustainable financial returns for investors whilst having a very positive impact on climate change. We have 3 strategic pillars to our company. Firstly, commercialize, which is about leveraging our advanced technology and our CDP into new projects. Scale up, which is all about building partnerships with scale into our target markets, namely North America, Asia, and Europe. And thirdly, monetize and grow, which is about taking our commercial scale projects and developing a global portfolio under license agreements. Today's presentation from us is framed around these 3 pillars of our strategy. It's just worth acknowledging very quickly, we align with the United Nations Sustainable Development Goals. The 3 most relevant SDGs to us is SDG 7, providing affordable and clean energy, SDG 9, industry, innovation and infrastructure, and importantly, SDG 13, climate action, where we are partnering with global corporations and governments in support of climate action. Last one in this section, we have a very busy 12 to 18 months ahead. We've got a long list of positive milestones and catalysts. Today, again, we're reiterating our guidance that our CDP, our commercial demonstration plant, remains on track for a second half of this year startup. We're making continued good progress on the procurement of the heat exchanger and the reactor materials, which Mark will talk to shortly. Secondly, we continue to drive forward our project in Canada with Suncor and Fortis, energy giants in North America. All of the engineering work around the reactor and the balance of plant is ongoing, and we are now working on definitive commercial agreements, which includes the license arrangements as well as offtake agreements for the hydrogen and the graphite streams. We're still targeting a final investment decision on that project by the end of this year. New project-wise, you'll have seen we're very pleased to have announced 2 new projects this year, one in Japan and one in Europe with Engie, leading partners. These transactions, again, just demonstrate that we're executing strategy. As Luke will elaborate, our pipeline is deep. We continue to work in our target markets of Asia, Europe, as well as North America. We continue to work very closely with Mitsui on our graphite and the marketing of our graphitic carbon. This is going very well. We're starting to see very strong interest in Hazer graphite from sectors actually that we didn't really anticipate. We'll share a little bit more about that today. As we go through this process, I'm becoming very confident on the value rate that we are establishing a value range for graphite due to the potentially broad-ranging application of it. And of course, our end game is marketing and offtake, and we are pursuing that aggressively for all of our projects that we'll have in the pipeline. Corporately, we continue to kick goals and get more runs on the board. You'll have seen we've achieved our ARENA milestone, again, accelerating $3 million of cash into the business, and we just recently announced the receipts of $9.5 million R&D cash rebate, which again further shores up our liquidity, maintaining our robust and flexible financing position. Moving on to our investment highlights, we've got really 8 key highlights. Our investment case is really compelling. We're a disruptive, low cost, low emissions proprietary technology with a very strong competitive advantage. One technology that serves 3 markets. Attractive returns and economics. We're on the lower end of the cost curve, very importantly. That's going to drive higher margins and larger cash flow generation as we start operating. We've got a rapidly expanding global footprint with tier 1 partners in our strategic markets, decarbonizing hard to abate sectors. Fourthly, we're an advanced technology. We've successfully scaled this up now 5 times, and we're now preparing our commercial demonstration plant for first production this year. Number 5, we've got a clear commercial pathway. We are CapEx light. What that means is we will enable early free cash flow as a licensor of our technology, eliminating the requirement for large licks of capital as we develop our technology and grow it into global locations. Number 6, as I've mentioned on the graphite side, we're unlocking the value for our graphite, which diversifies our earnings over 2 products, hydrogen and graphite. We've got the strong tailwinds of the energy transition, and we're right in the sweet spot. The market is large, as we'll demonstrate this morning. It's valuable, and it's growing at pace. And we're very also excited by the fact that we have strong government and policy support for hydrogen in a lot of our focus and target markets. We've shown this before. It just reinforces Hazer's low cost, low emissions advantage. There are current technologies for hydrogen that do face significant challenges. On the left-hand side, you'll see reference to steam methane reforming, or SMR. Today, SMR is 95% of the global supply market for hydrogen. So it's almost all of the hydrogen produced today. The significant downside with SMR is that for every kilogram of hydrogen that's produced, there's up to 11 kilograms of CO2. So it's not a climate solution, it's actually a climate problem. And it will require significant capital to abate that CO2 through carbon capture and storage, which is not really readily available today at scale. Secondly, on the left, electrolysis. Electrolysis, often referred to as green hydrogen, when it's plugged into a renewable energy source. it is very energy intensive and it's very high cost. In fact, it's 7 times more energy intensive to split water through electrolysis into hydrogen and oxygen than it is for Hazer to split methane into carbon and hydrogen. And of course, that translates directly into cost. And this, of course, for electrolysis ignores intermittency of power grids and renewables, as well as battery storage and other inefficiencies. Hazer is located very nicely there as a low cost, low emissions source. We're similar to steam methane reforming in that we use methane as a feedstock. However, we have graphite as a co-product as opposed to CO2 as a byproduct. So a very competitive position. We've got strong IP protection. We have been at this 15 years in terms of developing our technology and putting IP behind it and securing our patents. We have secured key patents in multiple jurisdictions around the world. We've got 4 IP families you can see there, focused on the iron ore catalyst, focused secondly on the morphology and the purification of our graphite. Of course, improvements in our top technology around the reactor in particular, as well as our trademarks. And today we've secured over 70% of our IP, our intellectual property, in 30 jurisdictions around the world. And we continue to receive approvals for patents and grants continuously. Today, I'll say we've never been challenged on IP, and every application that we have made for a patent, we have received. And generally speaking, if we receive one in the US and in Europe, generally we find the rest of the world follows in that respect. Advantageously, Hazer is a plug-in technology, and this will come up as a theme throughout the presentation. We are co-located with and integrated with end user infrastructure, such as refineries, as you can see in the picture on the left, a petrochemical plant, and this eliminates the requirement for shipping ammonia or liquefied hydrogen, both of which are unavailable to deliver hydrogen today. So you can see there is a good example of how we might fit into a refinery. LNG already does a very good job of moving methane molecules around the world, and we effectively will leverage that as a provider of technology that's integrated into existing infrastructure. That leads nicely into this slide, which really tries to highlight our cost advantage, comparing Hazer production cost to the landed cost of shipping green ammonia and green hydrogen or liquefied hydrogen to Asia. So that's the 3 right-hand bars. Hazer today can produce hydrogen without optimization for around $5 a kilogram into Asia. Okay, this is half of what it will cost to ship ammonia or liquefied hydrogen to the same market. And you can see that both of those technologies will require quite a long value chain to achieve that through liquefaction, shipping, and regassing or recracking ammonia. Neither of those pathways today are available as an end-to-end solution. And on top of that, we see the potential to drive down our $5 cost in Asia down to around $3.50, as you'll see shortly, taking into account learning curve as well as scale-up efficiencies. So this really reinforces our cost advantage by being co-located with end-user existing infrastructure, eliminating the requirement for shipping and regasification. For reference, we also show our position of Hazer-produced hydrogen in the United States, which of course is going to be much lower cost, given the cost of natural gas and power in the US is much lower than that in Asia. Global partners and projects, we've established strong partnerships with tier 1 partners, you can see there on the left, that are really serious about decarbonizing their portfolios, especially those that are operating in what we call hard to abate, difficult to electrify sectors like ammonia, cement, steelmaking, methanol, and others, petrochemicals, refining. On top of that, we're also working very closely with global and leading energy groups, engineering groups, such as the Hatch Group and the Wood Group, that are supporting both projects that we're developing, as well as supporting us in terms of the technology development. So these discussions are ongoing. Behind this, of course, is a long pipeline of potential opportunities for other projects and other partnerships worldwide. We've already scaled this technology up 5 times, so we're very well advanced. Our technology readiness is quite high on the scale already. In fact, as we've scaled up, we've benefited from not just the larger scale, but also the economies of scale and getting access to equipment and materials. So the technology has actually enjoyed being larger for us to scale up. And our focus at the moment is clearly on delivering the commercial demonstration plant, and behind that, then delivering the key projects in Japan, in Europe, and in North America that we've got in the pipeline. We've got an active R&D program at the moment. It's the core of our business, and it's one of our competitive advantages. We've got 3 main areas that we're focusing on: the process development, essentially how we scale up this technology and how we scale up our reactor to 10,000 tons per annum, 20,000 tons, and even larger as our customers demand. Secondly, we're unlocking the value of our graphite. It's a very versatile product, and we're currently identifying suitable high-value, high-volume markets and other potential offtake opportunities. And thirdly, on catalyst, iron ore, as I've mentioned, is a competitive advantage. It's cheap, yes, it's abundant, and it also enables that low-cost, low-temperature reaction to occur. That drives our low-cost model. How we source catalyst, process it, and transport it will continue to drive operating expenditure, and we see improvements to further drive this down. We've got a CapEx-light business model, very important. We leverage the strengths as a technology provider and licensor of the technology. This has the advantage of unlocking early free cash flow by avoiding large-scale capital exposure, enabling the delivery of cash flow from day one once we're operating. We'll achieve this through strong partnerships at the engineering level and the EPC level with groups such as Chiyoda, Suncor, Wood, Hatch, and others that are supporting our technology and our business. We've developed a revenue model that consists of a combination of license fees and royalties. It's fairly common for technologies. License fees will be linked to plant size, and royalties will be a percentage of our revenue or revenue from product streams. As I've mentioned a few times already, our graphite is versatile, it's potentially very valuable, and has very unique properties. It's high quality, up to 95% purity. It's importantly low emissions, and that's very attractive to certain customers. Last year, you will have seen in December, we joined forces with Mitsui under an MOU to explore the markets for our Hazer graphite, and this really helps to support and validate the potential value of this product. The earlier results that we've seen from that work has been very encouraging. We're starting to see wide-ranging interest from potential customers across a broad-ranging and diverse range of applications: steelmaking, water purification, lithium-ion battery technology, thermal energy storage, asphalt, concrete, just to name a few. In particular, we're getting quite strong interest from the steelmaking sector as a potential broad-ranging application for a replacement, as an example, a replacement of coking coal in the blast furnace, and also a riser in the electric arc furnace. So there's some really emerging markets for the graphite. And if you look at the chart on the right, it will give you a little bit of context in terms of the potential TAM, or the market size for our graphite. It could be as large as over 700 million tons per annum in terms of size or scale of market, with price ranges exceeding over $1,000 a ton. So something that we're obviously very keen to materialize over the coming months and years ahead. Here's a snapshot of the hydrogen market. Climate change, of course, is a problem. Hydrogen will be a key pillar to the solution. We're confident of that. It's a question of how big it's going to be. Most research out there suggests it's going to be growing in the order of 5 times by 2050 with the rise of the hydrogen economy. Goldman Sachs has estimated that it's going to take about $5 trillion of investment required in the supply chain to get to where it needs to be by 2050. Today's market on the left-hand side is almost 100 million tons per annum. To put that in context, the global LNG market is about 350 to 400 million tons. So this is already a quarter of the global LNG market. So it's large and it's very valuable. It's valued at around 170 to 175 billion dollars in 2022. So it's a significant market. All of that 95 to 100 million tons of hydrogen is produced by steam methane reforming, as I mentioned earlier. That gives rise to significant CO2 emissions, and that's Hazer's immediately addressable market today as a disruption towards and disrupting steam methane reforming as a technology. We'll see this grow into 2050. We expect to see significant growth in hard-to-abate industrial sectors. We're being approached by companies and corporations operating in these industries looking for decarbonisation solutions to steel making, cement making, power generation, and mobility. In our markets, we are seeing a strengthening support on fiscal policy and financial support to hydrogen technology and clean hydrogen. We are witnessing a clear shift from ambition to policy action. And just to call out a few, in Australia, the Australian government has just announced the Hydrogen Head Start program, which has committed $2 billion to industry. In addition to that, we've been the beneficiary of an ARENA grant up to $9 million, as well as $9.5 million in terms of our R&D tax refund. So great support here. In Canada, a little bit the same. We've received a grant for our Canadian project of $8 million to start with, which is great. And we expect further provincial and federal funding as we approach FID on that front. And I will also call out the US here. The United States has the Inflation Reduction Act, which is recently announced. It's very attractive supply side support, offering up to a 10-year tax credit worth up to $3 a kilogram for hydrogen. Now, we may not need all of that as a low cost, low emissions supplier, but it is potentially available for us when we start operating in the US. The recent Australia-US Climate Compact, we think, will help facilitate access to this indirectly or even directly. So we're excited about the potential of the North American market. Closing out this section, we wanted to include this because it just shows, again, the momentum for policy and government support to hydrogen. If you wind back to 2019, you'll see in the International Energy Agency report, first published on hydrogen, there was only 3 countries with national hydrogen strategies. Today, there's over 30 countries with national hydrogen strategies and roadmaps for hydrogen. So that's in the space of 2 to 3 years. So it's a really exciting space. We can see that governments are accelerating how they are going to bring hydrogen into their energy mix, and it's something that we're looking forward to taking advantage of as we develop commercial projects in many of these jurisdictions worldwide. I will now hand it over to Mark, if you don't mind, Mark, to give an update on the commercial demonstration plan.
Yeah, thanks, Glenn. Just going to the next slide. This here is our CDP south of Perth, and as Glenn mentioned earlier, this is our 5th stage of scale up, and importantly, it's our first fully integrated plant, which will enable us to collect all the technical operations and maintenance data needed to feed into the commercial plant designs that we're working on, and as well as a test facility for future catalyst and reactor prototypes such as the Mark II that is currently being developed. The plant was completed in the middle of last year, and we went into phase 1 operations, and that included doing testing and significant debugging of the operational issues and completing the first testing program ahead of the phase 2 hot operations, which is on track for the second half of this year. The project takes waste biogas from the otherwise flared gas at Water Corporation's waste treatment plant and turns it into hydrogen and graphite. So it's viewed as a very positive project, both in the local community and industry and the government. And that's demonstrated by the government support, with ARENA awarding one of its largest grants of $9.4 million to support the project. Next slide, thanks, Glenn. The current status of the CDP is we're in those final steps to bring it online. From the diagram, you can see there's only a small amount of equipment to install, most of which we already have on site. The remaining equipment we're waiting for is the 2 hot heat exchangers, of which we already have received all the specialist materials, and the fabrication has commenced. And the last item is the Mark I reactor, which has already passed the critical milestone of the materials forging and heat treatment. It's actually just in its final machining stages, and that's expected to be shipped to Australia, leaving in a couple of weeks, where we'll finish the fabrication and assembly. We've got started construction on site to get an early start on the furnace and the heat exchanger and supporting electrics. And once those last 3 remaining items arrive, we're confident to have all the plant and equipment installed by around the end of Q3. And that gives us a comfortable amount of time to complete the commissioning process and achieve hot operations, RFSU, in the second half of this year. Luke will now update us on the project pipeline.
Thank you, Mark. Good morning, everyone. Great to see you all. Thank you for taking the time and interest in Hazer. In the next couple of slides, I'd like to take you through some of the detail on the recently announced deals, as Glenn alluded to before, as well as Canada, which has been more widely published already. So on this slide, you see those 3 projects: Barad in Canada, a project in Chubu, Japan, and Montoire in France. It's relevant to note in this slide that in the next couple of slides, I will focus on the phase 1 of these partnerships. There is a very real potential for phase 2 projects, which are much larger capacities in the future. In Canada, as mentioned by Glenn already, we're working with energy giants Suncor Inc. and Fortis BC for a 2,500 tons per annum Hazer facility located at the existing Barad terminal, which is owned by Suncor. The use case there, it will be gas blending into the gas distribution network. So the hydrogen will go into the natural gas reticulation system. That's also determined the scale of this project, the capacity to remain under the safe thresholds for this gas blending. We decided to go for this capacity together with our partners. Important to note that the BC regulator, British Columbia, has also approved this blending as a use case in that part of the world. So important milestone for the project. The project, as Glenn mentioned, has already received 8 million Canadian dollars from the British Columbia provincial government, which covers the activities up to the FID decision, which is targeted for late 2023. The ultimate goal of this collaboration is a much larger facility at an existing refinery. Next one is Japan. This project is a tangible outcome of a relationship between Hazer and Shoda Corporation. Shoda is a global provider of EPC services with a very strong track record in the engineering of complex infrastructure such as LNG facilities, refineries, power stations across the world. We've been focusing with them on Japan, and we've now teamed up with Chubu Electric. For those of you that aren't familiar with Chubu Electric is the 3rd largest gas to electricity utility in Japan, providing energy, so electricity and gas, to an area with a population of 23 million people in central Japan, including industry as well. To provide all that electricity and gas, Chubu Electric consumes on an annual basis 12 to 15 million tons of LNG. And this is also exactly the reason why they wanted to work with us, because Chubu Electric has told us that they need to decarbonize. They've signed up to net zero by 2050. To meet those objectives, they have concerns around the pace and the availability of supply chains for hydrogen for import-export. As Glenn alluded to before, they're not going fast enough to enable Chubu Electric to meet its objectives. So they want to work with Hazer to maximize the use of their existing energy supply chains, LNG, the feedstock for the Hazer plant, and also their existing infrastructure, the regasification terminals and the power stations that they have available at present. So what we'll be doing over the next 12 months is we'll jointly prepare a project development plan for a Hazer facility of initial capacity between 2,500 and 10,000 tons per annum, which will likely be located at an existing regasification terminal and or a power station, depending on the site we ultimately decide to go for with our partners. The use case will consist of fuel for power generation, feedstock for heavy industry, such as potentially refineries or steel making, and mobility, or a combination of those use cases. And finally, we had the pleasure of receiving a delegation of Chubu Electric and Chiyoda recently in Perth in our office for a kickoff meeting for this project, technical discussions, and a site visit to the CDP. So it's great to be progressing this project with those partners. Last one out of the three is the first project in the EU, also the most recently announced one. This project is a result of a collaboration with ENGIE, the French multi-utility company based in France, Paris headquarters. Over the course of 2022, ENGIE, with input of Hazer, conducted a pre-feasibility study for an initial for a Hazer plant in France. In addition to the technical aspects that were covered under this PFS, one important outcome was that preliminary investigations in this study confirmed that a Hazer facility would be able to meet the EU frameworks, they call it taxonomy regulation, for low carbon hydrogen under EU regulation. So that's a really important milestone for that project, and also for us as a technology to confirm that we can meet those EU regulations for low carbon hydrogen. Under this extended collaboration, we will be again developing a project plan for for a Hazer plant with an initial capacity of at least 2,500 tons per annum. The site has been identified. It's an existing LNG regasification terminal in Montoir de Bretagne on the west coast of France, as you can see on the map there on the right. We recently had the pleasure to visit that site. Very impressive, strategically positioned in France, in Western Europe, for the energy transition of that part of the world. The hydrogen to be produced from this Hazer plant will likely be used in two ways: in industrial settings and also mobility from that plant. As Glenn mentioned earlier already, these three projects are the ones in our pipeline that have been publicly announced. Beyond these three, we have a significantly strong pipeline of potential partnerships with potential partners in key markets. Those markets include the US, selected countries in Europe, and also selected countries in Asia. Specifically, in no specific order, Korea, Taiwan, and Singapore are high on our list in Asia. Focus, as mentioned by Glenn, also is specifically on hard-to-abate sectors such as refinery operations and also steel making. Steel making is of particular interest because that's quite a unique alignment with the Hazer process because of the two products we produce, hydrogen as well as the graphitic carbon material. And on that point, I'll now hand over to Neil, who will talk about the monetization and the growth of the company.
Good morning. Thanks, Luke. Thanks, everyone. Looking forward to talking to you today about the growth and monetization part, the third pillar of our strategy. This slide recaps some of the items that Glenn covered previously, but basically the key points to note here are that the total addressable market for Hazer is an existing market. It's a significant sized market, as he touched on. Same value approximately as LNG, although a quarter of the volume, so a high value product. The SMR that we see here that we're looking to seek to replace or displace is a market now. It's CO2 intensive. Hazer will look through their processes to improve that position, and we can address that through lower emission outcome and products. The CMR in countries like the target markets Luke has alluded to in Asia, they don't have the capability to do carbon capture and storage in those locations, which is another competitive advantage that Hazer's product has over that existing addressable market. The first mover advantage is also available to us because we're a technology that's ready now, as we've seen in the earlier presentation and as Mark alluded to with CDP. Next slide, please. This slide shows the illustrative plant economics that we put together to show our audiences what a plant would look like at 50,000 tons per annum of hydrogen production. And as Luke alluded to, those are the sizes that are being considered by already existing customers and partners that we have. The NPV is very attractive at 20 years at roughly 400 million Australian. Project IRR of 24% on geared and a return on investment of 4 times for a plant of this size, should we build these with some of those partners we talked about earlier. The important part to notice here is that we have been careful with our economics, and what we're showing here is any cost before we optimize for gearing. And so IRR could be improved with some work with debt, for example. This doesn't include any non-repayable government grants or fundings that are likely to be enjoyed, as we saw in prior slides. And it does not also include the carbon tax offset that the plant owner could benefit from as the policy and government regulations progress and mature. As Glenn alluded to earlier, the Hazer returns then of a plant of this size. We are a CapEx light model. We're not investing in the capital at the front end of these plants. Therefore, that enables the early cash flow. The NPV that we would enjoy as the technology provider is from license fees and royalties, and that would be roughly 9700 million Australian under a plant of this size and scale. Looking at our growth ambition, as we've learned and heard from Luke already this morning, we've already enabled and have 3 projects, 2 of which MOUs were announced in only the last 3 months. So we're confident, therefore, in our growth ambition that we can get to 10 plants in 10 years, following this strategic model we've just described. The part of that, as Luke has already touched on, was to do with the significant demand pool we're already getting from industry. So it's they're looking to work with us across various industry segments to decarbonize their businesses. That's the growth and monetization part. So I'll hand over to, one more slide, beg your pardon. We talked about cost ambition already in the earlier slide, where we were talking about the various markets that we're serving. With respect to that, as Glenn already mentioned, Asia Pacific and Europe, slightly higher cost range right now because of the fact that we're using a higher gas than, say, in North America. That said, our cost range, our existing cost before applying any learning curve, is still extremely competitive in those markets. And through the application of learning curve, we are confident we can further improve those, as we show on the slide here on the right. The key things that we've identified already, and indeed we've already started working on, are looking at improving the gas conversion ratio in our reactors and in the plant. Mark has touched on the fact that we've already started doing that with a Mark II reactor that's being worked on, and the engineering's commenced on that, and we can see opportunity to improve cost and gas conversion. Graphitic carbon, we've been doing extensive marketing assessment with Mitsui and independently, and we can see a carbon price sale upside and pricing upside associated with that work. The economics shown previously are relatively conservative in that regard. The third potential to improve our learning curve is through energy use. Initial engineering by the company indicates we can improve energy use even further, and we've done it already in the first CDP. And With that in mind, then, we have a competitive cost now, but a clear pathway to improving cost even further as we progress and mature the plants. I think that is now the last slide for me, so I'll hand over to Glenn to recap.
Great. Thanks, Neil. That's a 30% cost reduction. If I may just go back, because I think it's worthwhile just pointing out on this slide, our ambition, of course, 10 plants in 10 years. If you put that 500,000 tons per annum into context, as we've spoken about, today's market for hydrogen is 100 million tons. So that's less than 1%. In fact, it's 0.5% of today's market. As Neil said, that feels achievable, feels realistic. And if every one of those plants can deliver, near on $100 million of NPV for Hazer, then we can see ourselves being a fairly significant company in the near term. I may just wrap up then before we open up the lines for Q&A. Look, we are a compelling investment case. We're an advanced technology, strong competitive advantage, as we spoke about, one technology, 3 diversified markets, hydrogen, graphite, and decarbonization. We're co-located with existing infrastructure, enabling that shorter pathway for customers to realize CO2 reductions and CO2 emission reductions in hard-to-abate sectors. We've got a very clear pathway now to commercialization, 3 projects already in the bag, and we've got an ambition to get to 10 in 10 years. We've got a CapEx light model that eliminates our need for large capital requirements and unlocking early free cash flow and attractive returns. We've got those, and we continue to build on our global partnerships across our strategic markets with tier 1 partners that believe in the technology and are looking for a decarbonization solution. And of course, we're in the sweet spot of the energy transition and the rapidly growing hydrogen market. So that's a great place to stop. I think, Krista, and open up the lines for Q&A. Thank you.
Thank you, Glenn. We will now move on to the Q&A session of this webinar. I'd like to remind you that if you wish to ask a question, please use the Q&A button at the bottom of your screen. We'll try to answer as many questions as we can during this time. However, if we don't get to your question, please submit it to the email address that was in your registration. So let's kick off with a few questions that we received in advance. The government recently announced the Hydrogen Head Start initiative.
Yep.
How is Hazer impacted by this initiative? And will you be proposing projects under the initiative?
Neil, if it's okay, I'll pick that up first, and then I'll hand it over to you. Look, we like the initiative. We think it's a great start for Australia. It's $2 billion of funding into hydrogen and hydrogen projects. We don't know the complete answers yet. We've spoken with ARENA, and they have indicated essentially where projects might be applicable. But Neil, we're quite encouraged about at least the initiative and how it might support Hazer in the short term.
Yeah, that's correct, Glenn. We have a very strong relationship with ARENA, as we've seen already with the 9.4 million grant that we got before for CDP. We did meet with them recently in Sydney and talked about the international scene regarding funding, and they were very amenable to us working with them, but they were request that we register and influence the commencement and development of that program next year in 2024. We'll be looking to expand the thinking. It's to not only funding projects, but also looking, for example, at funding companies like Hazer, who are technology providers, and there's precedent for that overseas as well. Good question.
Thanks, Neil. Looking at the CDP and the progress made there, just for clarification, is there an estimated date for delivery, installation, and operation for both the Italian and Canadian reactors? And can you clarify, when you talk about final fabrication of the heat exchangers are underway, does this mean it's commencing or it's actually being done currently?
Actually, I'll answer that, Mark. If you want to add, you can. I mean, it means they're currently sitting in the shop, being fabricated as we speak. The materials have arrived for the heat exchanger. They are sitting with the contractor, and they are going through the fabrication process in order to meet our schedule. So we don't see any surprises at this stage. But Mark, would you like to add anything to that?
No, that's correct. They're working on it at the moment. So yes, it's actually it is being fabricated. For the Mark 1 reactor, I'd say that's all the main shells, all the other components are finished. The main shells are just doing final machining, so that's expected to finish within a bit under 2 weeks, and they'll be shipped to Australia, which will commence the assembly. And the Mark 2 reactor is in detailed design with orders going out in the next sort of month type time frame. We expect to have that delivered, completed on site in around the start of next year.
Yeah, and I'll just add to that, Mark, if it's okay, because we've continuously looking at our schedule for how we can accelerate. I think we've been very clear with the market around the contingency that we built into the plan. We've got 2 heat exchangers that are currently being fabricated, and we've got 2 reactors and reactor materials. So we've built in all of this contingency to account for some of the issues we experienced about a year to a year and a half ago. So we feel confident where we are with our schedule. We're now even more confident that these materials are arriving in Australia and they are being effectively fabricated. So, you know, our goal is to get to, as Mark said, mechanical completion in September. That allows all of our hot equipment to be installed and then ready for effectively the commissioning phase, which will prepare us for ready for startup.
Some follow-up questions around that on the CDP. How much methane per annum could be sourced and used by the Hazer process from a typical compatible sewage plant? And what is the projected output for the commercial demonstration plant? And would a scale-up project be located in Australia following that?
Possibly. I'll talk to the scale, and then perhaps Mark or Luke, you could talk to the feedstock side. The CDP is currently designed for up to 100 million tons per annum of hydrogen, and you know, that's the design limits for it. That's also 300,000 tons per annum of graphite. So it's a sizable plant. In Canada, we're going up 25 times to 2,500 tons per annum. So I think I should have said 100,000 tons per annum rather than 100 million. But so it's a 25 times scale up of our technology into Canada, and that will require a reactor that will deliver, as I said, you know, 25 times the scale of what we're doing in the CDP. So we've achieved a lot of what we wanted to achieve in terms of scale up potential. If you think about where we're going from here, in terms of 5,000 or 10,000 tons per annum, our scale up is only 3 or 4 times. So we're over the hump in terms of the large scale jumps in technology scale up. So, and that's the $70 million that we've committed to developing the technology. So we are at a very important point of about to go into the commercial phase, given that we have already scaled up now 5 times. Mark or Luke, did you want to add to the point on the feedstock side?
Yeah, I'm happy to talk to that if that's okay, Mark.
Yeah.
So for the first, of course, the point, the technology doesn't care where the methane comes from. We've spoken about LNG, natural gas. Biogas is another very attractive feedstock because it's 100% renewable feedstock. The CDP is located on the Woodman Point wastewater treatment plant here in Perth. It's not the biggest wastewater treatment plant in Australia or in the Asia Pacific region for that matter, but it produces a significant amount of biogas. So at the Woodman Point location, for example, we could increase the capacity in terms of feedstock availability by at least a 7-fold before we've maximized the feedstock capacity. Just to be clear, I'm not saying that that's the plan that we're doing. It's just the feedstock that's available. More broadly, there's way more wastewater treatment plants, landfills available. Landfills also produce a very significant amount of biogas and methane, which could be captured by the Hazer process rather than being only used for energy production, or even worse, ending up in the atmosphere.
So I've just noticed a question here, if it's okay, from Roger in terms of the graphite and how's that been factored into the NPV. I think, to be clear with people, we effectively take the royalties from only the hydrogen stream as well as the graphite stream today. We're not accounting for any decarbonisation revenue, so that's upside. And to try and be a little bit more conservative in that front. And we have, in our views, lent towards the lower end of the valuation or the price range for graphite. As you will have seen in the pack, we anticipate the price range anywhere between $100 a tonne and up to $1,500 a tonne, depending on what industry or application. I think, Neil, we're kind of about $300 a tonne.
About $400 a tonne was used in the economics. It's at the very low end of the range that we've just described. That, as I said, in the learning curve, that will be part of the upside we expect to enjoy with further, more mature marketing assessment with Mitsui and with the independent work that Luke's been leading.
Yeah. Just ticking off questions here, James. I think you've asked a question on the Mark II reactor. What's the advantages of that? Well, the advantages is preparing us for scale up. We're using a hot wall reactor in our CDP. The Mark II reactor that we refer to in our communications with market and today refers to the next generation of reactor. It's a more advanced reactor, more efficient, and enables us to scale. I will mention also that and you will have seen in the video that the reactor is a fluidized bed reactor, and that is already established technology. So we're not dealing here with anything that is not being dealt with in industry before. If you think about where fluidized bed reactors have been utilized, they've been utilized for many decades in the petrochemicals industry. So we're effectively adopting that technology and using that to Hazer's advantage. Mark II is bigger, it's better, it enables us to prepare for the scale up for Burrup and also into the next phases in Japan, Europe, and hopefully into other projects globally. I think Helen, Christopher, if I may, on Helen's question relating to green hydrogen. Look, I think I tried to mention this in the very beginning. Green hydrogen is often referred to hydrogen that's produced using electrolysis that is plugged into a renewable power grid. Now, as we've tried to explain in one of our slides in the investment highlights, that green hydrogen actually today is actually very costly. And actually the thermodynamics of it is actually quite simple. If you think about the molecular bond of water relative to the molecular bond of methane, which is what we crack, it's 7 times stronger in water than it is in methane. So it's actually much lower energy intensity to split methane than it is to split water. And that's the fundamental difference between the cost of green hydrogen and pyrolysis today. It's not widely understood at this point, but you will start to see as the industry emerges the cost challenges that green hydrogen will face. And that is before you produce the hydrogen, then you've got to transport it and then crack it or regas it into a market. The advantage really of Hazer is that we plug into a market in Asia, Singapore or Korea and produce hydrogen at the site where it's demanded by the customer. We eliminate all of the requirement for transporting, shipping, regassing, and all of the other challenges that potentially come with transporting green hydrogen or even using another vector like ammonia. or methanol to transport it. So it's one of the unique opportunities and advantages of using Hazer technology.
If I may add to that as well, Glenn, the point with green hydrogen is it's a single product as well. In Hazer's case, we have the hydrogen and we have the graphitic carbon. So we don't have a waste product, we have a second product, which is a saleable revenue stream as well. And it's proved to be very attractive in a number of markets, as we touched on the Mitsui marketing study and our own analyses.
Yep.
Can you talk through which research institutions you're currently working with?
Yep, I can mention that, and I think Mark, you could perhaps add. We work very closely with a lot of universities in Australia. Of course, the technology emerged out of UWA, which was great. Andy Cornijo's research. And we now spend a lot of time dealing and working with the University of Sydney. We've been working with some experts globally as well in carbon market development. Our lab in Sydney continuously supports our development of our CDP and our technology on all aspects of our R&D, the process improvements, the catalyst, as well as the graphite side. So we're very privileged to be working alongside universities worldwide, as well as just receiving grants along the way to help and support our R&D. It's a unique technology that requires a lot of research, and we are currently, I guess, adding to our bench in terms of R&D. And I did see a question: is Andy Cornijo still with our firm? Yes, he is. But it is worth mentioning that he is going to be transitioning away from Hazer. Andy has been an absolute rock to Hazer. It is his technology that has been developed here. He's a friend of the firm, but Andy has reached a point in time where he's got other itches that he wants to scratch in terms of developing other opportunities. We're going to be sad to see him leave later in the year, but we're ensuring that that is a smooth transition. We have added to our R&D bench strength. We have Tim Forbes, who has just joined us. He has got 15 years with ExxonMobil. He is an expert in fluidized bed reactors worldwide. He's worked on technology development for over 10 years. He spent a bit of time with FFI as well, and he's now jumped the fence to work with Hazer. So we're very excited to be working with Tim, Andy, and other members of the R&D group as we develop our R&D and our technology. All right, Krista, I'm just scrolling down the list. It looks like we've covered off most of the points. Well, is it probably a good time to wrap up then?
Yes.
Unless there's any other questions. Well, then maybe I can just say a few final words. Look, we are focused on performance and delivery to unlock the full potential of our business and our technology. And hopefully you can see that today. We remain firm on our guidance to deliver the CDP this year. We've made continued good progress, as Mark has outlined, and we'll continue to update the market and investors if anything changes in this respect. I guess what excites me the most about what we have is we're building partnerships with the world's largest industrial firms that are seeking to accelerate their decarbonisation strategies, and they've chosen us, and that's in line with our vision of helping global corporations and governments transform industry to contribute to a sustainable future for the next generation. I'd just like to thank shareholders and all of those observers and investors that are following our story and continues to support us in terms of what we're building. I will just say on behalf of the team, it's an honor, but it's also a challenge to lead Hazer, and we look forward to developing and delivering our strategy over time. Thank you very much indeed for joining today.
Thank you, everyone.
Yeah, thanks.
We'll now end the webinar. Please note that a recording of the webinar will be posted on the Hazer website in the coming days.